In this video, we're going to be performing a deep dive on Cardinal Health's dividend safety. To begin, let's talk about Cardinal Health's business model. Cardinal Health is one of the big three drug distribution companies along with McKesson and AmerisourceBergen. Cardinal Health serves over 24,000 United States pharmacies and more than 85% of the country's hospitals. The company has operations in over 60 countries with approximately 50,000 employees. Cardinal Health is a well-known dividend stock because of its compelling track record of dividend growth. With 32 years of consecutive dividend increases, Cardinal Health is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, Cardinal Health's high dividend yield combined with several industry-specific factors, including the price war among drug distributors and the potential entry of Amazon into the pharmaceutical space, has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Cardinal Health's dividend safety in the context of the company's current earnings. When Cardinal Health reported first quarter financial results on November 8th, the company provided financial guidance for the full fiscal year. Cardinal Health expects to generate adjusted earnings per share between $4.90 and $5.15 for the 12-month reporting period. For context, Cardinal Health currently pays a quarterly dividend of 47.6 cents per share. This implies a payout ratio of just 38% for fiscal 2019. Using earnings, Cardinal Health's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Cardinal Health's current dividend payment to its free cash flow. In the first quarter of fiscal 2019, Cardinal Health generated $365 million of cash from operating activities and spent $58 million on capital expenditures for free cash flow of $307 million. The company spent $150 million on common share dividends during the same time period for a free cash flow payout ratio of 49%. Looking out over a longer time horizon, our conclusion is the same. In fiscal 2018, Cardinal Health generated $2.8 billion of cash from operating activities and spent just $384 million on capital expenditures for free cash flow of $2.4 billion. During the same time period, Cardinal Health spent just $581 million on common share dividends for a payout ratio of 24%. Using free cash flow, Cardinal Health's dividend safety is just as robust as when we used earnings. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Cardinal Health's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Cardinal Health's performance during this time period is shown here. While the company's performance appears quite horrific, it's important to keep in mind that Cardinal Health's financial results around 2009 and 2010 are materially impacted by its spin-off of CareFusion Corporation, which was completed on September 1st, 2009. Despite this spin-off, the company's segment revenues, segment earnings, and per-share dividends continued to grow during this time. With this in mind, we believe that Cardinal Health is a very recession-resistant business, and its dividend safety is unlikely to be impacted by short-term economic contractions. The last angle that we will use to assess Cardinal Health's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. In fiscal 2018, Cardinal Health generated $329 million of interest expense and had $9.0 billion of total debt for a weighted average interest rate of 3.7%. The following image shows how changes to Cardinal Health's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As the image shows, Cardinal Health's weighted average interest rate would need to rise to above the 25% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Cardinal Health's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Cardinal Health's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.sharedividend.com.